again, welcome back to the second part of the module of money market funds. In the first part of the module, we have discussed some key concepts related to the money market funds. In the second part of the module, we will look at different types of MMFs. We are going to learn about short-term and standard money market funds, as well as public debt, constant net asset value MMFs, low volatility net asset value MMFs, and variable net asset value MMFs. Before I start, let me again make a disclaimer that the presentation do not necessarily represent the views of the ESRB or its member institutions. Okay, let's start discussing different types of money market funds. Money market funds can be distinguished as either short-term MMFs or standard MMFs. This distinction is based on the maturity range of assets funds invest in and duration and credit risk they can take. Money market funds can also be classified as public debt constant net asset value MMFs, so-called PD-CNAVs or simply CNAVs, low volatility net asset value MMFs, so-called LVNAVs, and variable net asset value MMFs, so-called VNAVs. Those funds differ in types of assets they can invest in, liquidity requirements, and valuation methods they can use. In the next couple of slides, we will discuss the characteristics of different types of MMFs. So to start with short-term and standard MMFs. Short-term money market funds have the objective of offering money market returns while ensuring the highest possible level of safety for investors. Duration risk and credit risk of short-term MMFs are kept at low levels. Standard money market funds have the objective of offering returns slightly higher than money market returns. This means that they can invest in assets that have an extended maturity compared to short-term MMFs. Compared to short-term MMFs, standard MMFs can also take higher duration risk and higher credit risk. Short-term money market funds can take form of public debt constant net asset value MMFs, low volatility net asset value MMFs, and variable net asset value MMFs. Standard MMFs, on the other hand, can only be variable net asset value money market funds. To reduce the portfolio risk of money market funds, there are limits for a maximum allowable weighted average life and weighted average maturity of their portfolios. Now, weighted average life is used to measure the credit risk of an MMF. The longer the reimbursement of debt instruments principal is postponed, the higher the credit risk. Weighted average life is also used to limit the liquidity risk of MMF's portfolio. It is the average time to legal maturity of all the underlying assets in the MMF, reflecting their share in the portfolio. The maturity used for calculating the weighted average life is the residual maturity until legal redemption, as this is the date on which the instrument should be reimbursed. Now, weighted average maturity is used to measure the sensitivity of MMFs to changing money market interest rates. It is calculated similarly to weighted average life with one important difference. In contrast to the calculation of weighted average life, the calculation of weighted average maturity for floating rate securities and structured financial instruments takes into account interest rate reset dates. In other words, maturity used for calculating the weighted average maturity is the time to legal maturity of an instrument, or, if shorter, the time to the next interest rate reset to money market rate. To better understand this concept, let's have a look at an example. Say today is 29th of August, and we want to calculate maturities of a floating rate bond to determine weighted average maturity and weighted average life. The next coupon payment of the bond is at the end of August, and the bond matures at the end of September. In this case, bond maturity that we can use for calculations of weighted average maturity is 2 days, as this is the time to the next coupon payment and when the interest rate paid by the bond will be reset. On the other hand, bond maturity we can use for calculation of the weighted average life is 32 days, as this is the time until legal redemption of the bond. In the chart on the right-hand side of the slide, you can see the weighted average life and weighted average maturity of EU money market funds. At the end of 2021, they amounted to 54 and 44 days, respectively. In the next part of the module, Christian will explain the detailed requirements on weighted average life and weighted average maturity for different types of money market funds. Money market funds can also be classified as CNAVs, LVNAVs, and VNAVs. And in this slide, you can see a brief overview of their basic characteristics. So public debt constant net asset value MMFs and low volatility net asset value MMFs can offer a stable dealing net asset value. To be able to do that, they use amortized cost valuation, and their net asset value per unit is rounded to the nearest percentage point or equivalent in currency terms. Variable net asset value MMFs, on the other hand, do not offer stable dealing net asset value and use mark-to-market or mark-to-model valuation. Their net asset value per unit is rounded to the nearest basis point. While there are some additional investment restrictions for CNAVs beyond those mentioned in the beginning of the module, there are no additional investment requirements for LVNAVs and for VNAVs. Let's now have a look at public debt constant net asset value MMFs. CNAVs have the objective of preserving the capital of the investment and ensure a high degree of liquidity. They try to maintain a stable net asset value per unit, for example, at €1. This means that investors should be able to buy and redeem fund units at this stable price. Income in constant net asset value MMFs is accrued daily and can either be paid out to investors or used to purchase more units in a fund. Almost all assets of CNAVs must be invested in government debt securities, reverse repos collateralized with government debt, and cash. Now, of course, the market value of assets held by CNAVs can be subject to fluctuation. This could result in a situation in which the market value of a unit might not always equal the stable value per unit. So, for example, €1. To address this, CNAVs employ amortized cost valuation method. This valuation method takes the acquisition cost of an asset and adjusts that value for amortization of premiums or discounts until maturity. Nevertheless, CNAVs should also calculate and publish the value of their net asset on the basis of mark-to-market or mark-to-model, and monitor the difference between the value per unit and the constant net asset value per unit at all times. Now, to better illustrate how the amortized cost valuation works in practice, let's have a look at this simplified example. Let's assume that we buy a zero coupon commercial paper for €999 that will mature at face value of €1,000 in 30 days. Amortized cost valuation method assumes that the difference between those two values, meaning the discount of €1, is proportionally added to the purchase price over time. So, for instance, after 15 days, the value of commercial paper based on amortized cost valuation would be €999.50. Low volatility net asset value MMFs can invest in a broader range of assets than CNAVs, including commercial paper and certificates of deposits. Similarly to CNAVs, LVNAVs can offer subscriptions and redemptions at a constant net asset value per unit. However, this can only be the case provided that the market net asset value of the fund does not deviate from the dealing net asset value by more than 20 basis points. When the net asset value breaches this collar, LVNAVs need to use mark-to-market or mark-to-model valuation for all of their assets. When this happens, redemptions and subscriptions are undertaken at the price that is equal to the net asset value per unit, calculated based on mark-to-market or mark-to-model valuation method. To be able to offer a stable dealing net asset value, LVNAVs can use amortized cost valuation method. But contrary to CNAVs, LVNAVs can only apply this valuation to assets that have residual maturity up to 75 days. However, if the difference between the market value of any asset and the value according to amortized cost valuation method of that asset does deviate by more than 10 basis points, the price of that asset must be calculated using its market value. And finally, variable net asset value MMFs. Those funds can invest in a wide range of assets, including government bonds, commercial paper, and certificates of deposits. VNAVs do not offer stable but fluctuating dealing net asset value. They cannot use amortized cost valuation method and instead use mark-to-market or mark-to-model valuation. Let's now have a look at some data. As you can see in the chart on the left-hand side of the slide, low volatility net asset value MMFs are the largest part of the European MMF sector, while the constant net asset value MMFs are the smallest. As shown on the chart in the right-hand side of the slide, most CNAVs and LVNAVs are domiciled in Ireland. Most variable net asset value MMFs are domiciled in France when they are the only type of money market funds. To summarize, here are the main takeaways from the second part of the module. In the EU, there are 4 types of money market funds. Those are short-term CNAVs, short-term LVNAVs, short-term VNAVs, and standard VNAVs. Money market funds can offer stable or fluctuating dealing net asset value. And finally, some money market funds can use amortized cost valuation method. I hope you enjoyed learning about different types of money market funds. In the last slide, you will find some suggestions for further reading. Thank you for your attention.